When it comes to investing, especially if you want to have some regular income from your investments, dividend ETFs are a pretty cool choice. Now, in this vast sea of options, two names really stand out. The Schwab U.S. Dividend Equity ETF, which goes by SCHD, and the Invesco S&P 500 High Dividend Low Volatility ETF, known as SPHD. So the burning question is, which one of these ETFs is the better pick for investors? Well, I'll be unpicking that in this video, and by the end of it, you'll have a clearer idea of which one is best for you. All right, first of all, let's start with SCHD, the Schwab U.S. Dividend Equity ETF. The folks over at Charles Schwab have set it up with a pretty clear goal in mind: to stick as close as possible to the Dow Jones U.S. Dividend 100 Index before we even start talking about fees and expenses. This index? It's all about picking companies that not only pay out dividends, but are also really good at keeping that up over time. We're talking about quality and sustainability here. Since kicking off in 2011, SCHD has grown quite a bit, now managing a hefty $52.0 billion. And what makes SCHD and SPHD different? We have to look at their portfolios, starting with SCHD. It's got 102 stocks in its bag, and the top 10 of these take up over 40% of the whole fund. The big players here include names like Broadcom, AbbVie, and Home Depot, among others. This setup tells us SCHD leans towards companies that are not just about dividends, they're also about growth. It's a mix that suggests a belief in the future growth of these companies, alongside their solid dividend payouts. On the other side, SPHD keeps things a bit tighter, with 51 stocks, and its top 10 holdings account for less than 30% of the fund. This list features companies like Altria, AT&T, and Verizon, pointing towards a strategy that might be seen as a bit more cautious, with a focus on sectors known for stability and reliable dividends. So when you're comparing these two, SCHD might appeal to you if you're looking for a mix of growth and income. It's like looking for investments that can pay you now and potentially grow over time. SPHD, however, might be your pick if you prefer a smoother ride, with its spread-out approach aiming to reduce bumps along the way, focusing on steady dividend payers. Now, one thing I want to make clear here is that these stocks don't necessarily feature the highest dividend yields. Take Broadcom and Home Depot and SCHD's lineup, for example. Broadcom has a current dividend yield of 1.7%, and Home Depot is at 2.4%. Not the highest, right? But over the years, they've given back loads in total returns. This isn't just about what they pay out in dividends. It's also about how their share prices have climbed. Broadcom, it's skyrocketed with a total return of 2,629% over the past decade. Home Depot isn't too shabby either, with a 453.3% return. That's the magic of mixing dividend payouts with share price growth. Switching gears to SPHD, it's a bit different. It leans towards companies that are more generous with their dividends right now, but maybe don't have as bright growth prospects. We're talking companies like Verizon and AT&T, plus some real estate investment trusts like Simon Property Group. These are the types of stocks that make your dividend yields smile, with rates like 6.8%, 6.7%, and 5.1% respectively. It's a different strategy focusing on the here and now of dividend yields. Now, there's this thing called the TipRanks Smart Score system that rates both SCHD and SPHD. This system ranks stocks on a scale from 1 to 10 based on a bunch of market factors, with anything 8 and above meaning it's expected to do pretty well. Looking at SCHD, 8 of its top 10 holdings are shining with scores of 8 or more. SPHD? Not so much, with only one top holding hitting that mark, while the others are more in the doing okay zone. Yet, when you tally up everything, both ETFs sit at a respectable 7 out of 10. But what does this all mean for you? Both ETFs are smartly put together, but they're playing different games. SCHD's strategy, which is focusing on those not just paying dividends but also growing in value, has really paid off over time. We're going to dive a bit deeper into this, but it's clear one approach has been a bit more rewarding so far. The next thing is how these both stack up against each other performance-wise and related fees. Starting with performance, SCHD, which loves its mix of growth and dividend-yielding stocks like Broadcom and Home Depot, has been pulling ahead of SPHD. As of the end of December, SCHD's got a 3-year annualized total return of 9.5%, just nudging past SPHD's 8.7%. It might seem like a small lead, but the gap widens the further back you look. Over the last 5 years, SCHD doubled its performance compared to SPHD, clocking in at 14.0% against SPHD's 7.0%. And over 10 years, SCHD's at an annualized return of 11.0%, outperforming SPHD's 8.7%. Now let's talk about what this costs you. Even though SCHD is outperforming SPHD, it's also cheaper to own. SCHD's expense ratio is super low at just 0.06%, while SPHD's is higher at 0.30%. In real money, that means if you put $10,000 into SCHD, you're only paying $6 a year in fees. Do the same with SPHD, and you're paying $30. Might not sound like much over a year, but let's say both funds give back a 5% return annually and keep their current expense ratios. Over 10 years, you'd spend $77 in fees on SCHD versus $381 on SPHD. So that was some metrics about these two ETFs, but to give you a better idea, I'm going to share what the analysts are saying about these two. When it comes to SCHD, it looks like Wall Street is leaning towards a moderate buy. The majority of analysts are giving it a thumbs up with a buy, and a few are sitting on the fence with holds. They're thinking the price could go up by about 6.7% with an average target of $80.77. Switching over to SPHD, it's getting a similar vibe with a moderate buy rating. This time, a majority of analysts are in the buy camp, and a few are holding steady, and just 2 are not recommending it with a sell rating. Their average price target for SPHD suggests a potential upside of about 5.1%, coming in at $44.56. So what's the deal for investors? Both ETFs have their merits and have been putting positive numbers on the board for a while. But when you put it all together, SCHD stands out as the champ. Yes, SPHD might tempt you with its higher dividend yield right now, but SCHD has been the one delivering the goods over time, offering superior total returns and costing you less in fees. Digging into their portfolios, SCHD's mix of dividend payers that also have room to grow, like Broadcom and Home Depot, has really paid off compared to SPHD's approach, which leans heavily on those higher-yielding but slower-growing stocks like AT&T, Verizon, and Simon Property Group. Bottom line, I'm leaning towards SCHD. It's shown that it can bring home the bacon with a strategy that pays dividends, literally, and promises growth. For anyone looking ahead, wanting to make their investment count, SCHD seems to be the way to go. Remember, this is only my opinion and should not be taken as financial advice. Be sure to do your own research and get in touch with a professional financial advisor before investing any money. If you're looking to grow your dividend portfolio, I'd suggest you watch this video next to find out the 5 best dividend stocks of 2024, in my opinion.